Hey, it's Rocky. Welcome to Richer Soul. Today's guest is Brian, who's going to share how to beat the experts in picking stocks. Imagine it's 12 months from now, and you've achieved your major life goals. How does it feel to be in the best shape of your life? To wake up energized, excited about the day? To have great relationships and friends who support you and propel you forward? How does it feel to have an excess of money, to be able to make the choices you want? To be fearless and open to trying new adventures? Imagine being connected to the universe and it providing everything you desire. It's possible over time, and your past does not dictate your future. The only thing holding you back from this vision is you. It's time to take control of our thoughts and use them to our advantage. Welcome to Richer Soul, where we achieve our dreams and bring balance to health, wealth, relationships, time, and spirituality. If you have not had a chance to listen to episodes 1 through 9, I encourage you to go back and listen to the framework behind Richer Soul and how to create the life of your dreams. You can also find all the show notes for this episode at richersoul.com. While you're there, you can sign up for a monthly email where I share the best articles I read this month, let you know about upcoming episodes, and share a little wisdom. You can also listen to coaching calls under the Coaching Calls tab. I also share the most interesting articles I read every week on Facebook at facebook.com/Richer Soul. And there's also a Facebook group where you can ask questions and interact with other listeners. Today's quote is from Mark Twain. There are some things that can beat smartness and foresight. Awkwardness and stupidity can. The best swordsman in the world doesn't need to fear the second best swordsman in the world. No, the person for him to be afraid of is some ignorant antagonist who has never had a sword in his hand before. He doesn't do the thing he ought to, and so the expert isn't prepared for him. He does the thing he ought not to do, and often it catches the expert out and ends him on the spot. That's what we're talking about with our guest today. How to take on experts in investing and win. Today's focus is on relationships. The power of relationships and the doors they open are amazing. Brian and I are in a group together. That group allows me to connect and build relationships with others who share the same interests with me. I'm always going to meetups and events where I can meet more people who like to talk about money. Connections are everywhere, and it's usually not your first-level connections that help you, but rather a friend of a friend or someone you rarely talk to. Creating a system to make sure you can track your relationships and then ensuring that you keep providing value to them is important. It's been a struggle for me to keep up with so many people. I forget sometimes. As it is, I've had over 100 guests on the show alone to keep up with. I keep working on improving my systems and doing a better job. Today's guest is Brian Feroldi. Brian has been striving for financial independence even before he knew what the term meant. Brian struck gold right out of college when he was hired at a successful medical device company soon after it was founded. However, he spent all his free time on his true passion, investing. He struck gold again in 2015 when he was hired by Motley Fool to cover the healthcare industry for Fool.com. He's been doing it ever since. Brian currently resides in Rhode Island, where he's happily married and is working hard to raise 3 small kids. Brian's hobbies are playing games of all types. Chess and Fortnite have his attention right now. Volunteering at his kids' activities, hanging out with friends, and cheering on the Patriots. Well, we can't all be perfect, can we? Let's meet our guest. Welcome to Richer Soul, Brian. It's great to have you join us today.
Thanks, Rocky. It's awesome to be here.
So, let's start at the beginning. What was it like when you were growing up, and how much did your family and school teach you about money?
Well, I think like most people, my school taught me nothing about money, but I was blessed enough to have parents that were not experts at money, but they instilled in me through their actions the importance of frugality, the importance of saving. We didn't really ever talk so much about investing, but I remember my dad saying to me multiple times when I was a kid, he was like, Mommy and Daddy could have any car that we wanted. We could drive BMWs, we could drive Mercedes, but we choose to drive low price cars because that's what we value. We don't value cars. We value saving. Just by watching them was a wonderful lesson for me for the value of a dollar and that money should not be wasted. We did live a good life. We went skiing a lot. We had a second home in New Hampshire. But when we were at the ski resort, we always brought lunch with us, right? The concept of going somewhere and buying food was just completely foreign to me. They taught me by example, which I think is the best way to teach.
It very much is. Kids don't listen to what you say. They listen to what you do. And so you have to lead by example or that is not going to happen.
Right. And for some strange reason, I think some people are just natural savers. They are born to just save money. That's just my personality. I remember when I was a kid in high school, I used to take the lunch money that my parents gave me and I would buy candy bars with it instead of food, which is obviously terrible for my nutrition. But when I got these candy bars, I didn't eat them. I would take them home and I would keep them in my drawers. And I would have this candy bar collection that I accumulated over time through just being at school. And I remember I would love it when I had like 3 packs of Skittles and 2 packs of like Swedish Fish. And I would not eat them. I would just collect and save them, which is a really weird thing for a teenager to do. But that's just the personality that I have.
Did you ever eat them or did they just sit there forever?
I think I eventually ate them when I really wanted one, but I would guess that more if they just sat there. I like the feeling of having them and collecting them more than I like the feeling of eating them.
Well, at least it's good for your health that way, right?
Yes, yeah, there you go.
The other thing is selling them and then doubling your money. Buy them for 50 cents and sell them for $1.
If I was smart, that's what I would have done. I would have flipped them and used arbitrage there. That's what I should have done.
Yeah, the lessons we learned. So you have kids. Are you doing anything different or what are you doing to teach your kids about money?
Yes, I do have kids. I have 3 kids. They are 8, 6, and 4. I read a blog post by Mr. Money Mustache about how he started a savings account for his son, and the way that he made it exciting was to pay them 1% interest every month. So whenever they get birthday money or money from like any holiday or anything like that, I take that money and I save it for them and I put that into my Excel spreadsheet. And then every month or two, we go over to the spreadsheet and I show them how much free money they got from their investments. So let's say they have $300. I'm like, look, this month you made $3 in interest. And I try and drill in them. What did you have to do to get that? And they like saying, nothing. And I'm like, that's right. Your money is working for you. You are saving it and it is creating money. So that is the primary way that I'm teaching them now. I also have bought a handful of individual stocks for each of them. They had a little bit of a selection. So I bought EA, the Electronic Arts, the video game company for my son. And I each bought them a share of like Tesla and Netflix and Stitch Fix and just businesses that I think that would be somewhat interested to them. My son, who's 8, seems to be the most interested in this stuff. My girls are 6 and 4. They don't seem to be very interested at this point, but I look forward to being able to show them over time that this stock that I bought for them, that is a business that they know, has grown. And that's the lesson I'm trying to teach them now.
And there's also the lesson to see what happens when they drop, because that's really where the learning begins.
You got that right. My son bought EA, for example, at I think like 115. It went up to like 145 because of a good earnings report. And now after this market drop, it's down to 78. So it's down quite a bit, but he isn't freaking out. He doesn't care. He likes EA's video games. So the thing I'm trying to teach him is it doesn't matter where the stock goes. It matters about the business. So I hope this is a learning lesson for him.
And they all are. Something unique about you. You have a very high savings rate. Can you share that?
Yes, my savings rate historically, when my wife and I were both working and had no kids, topped out at 60, 65%. Some months it was very high. As we've added kids and I've taken on a new job, it has dipped, but we are still in about 25, 30% savings rate. But considering that we have children and everything like that, I'm pretty happy with that.
So how do you get to such a high savings rate?
It's like anything. It's a combination of finding a job that pays good and then intentionally spending your money in certain ways. One thing that we did is my wife and I were both working and we were both making great incomes. And when we were living in New Jersey, for example, we rented and we looked out at all the apartments and we chose the lowest price one that was acceptable to us. When we had friends in the exact same area with probably less income than we did that were willing to pay $500 more in rent just to have a slightly nicer place. We rarely eat out. We always cook meals at home, even though we could eat out far more often than we do. We drive cars for way longer than the average American does. As you know, it's just intentionally living and focusing on what you value and how to get the most value out of your money instead of just spending every dollar you make.
And I think that's the important thing. Be intentional, figure out what's important to you, spend on where you prefer to spend, and then don't waste your money on things that don't bring you value. But you do have to make judgment calls. You can't have everything. You've got to make choices to where is it that you're going to keep your spending low so that you can save. And the bigger you can make the gap between the income coming in and the dollars going out, the more financial freedom you can build and the more freedom you have in life to be able to do what you choose.
That's the name of the game right there. And one thing that I've always done is I've kept Excel spreadsheet of all my expenses. And it is a manual process that I go in there. And whenever I spend money at the end of the month, I put it into my spreadsheet. And I've been keeping track of this for like 15 years now. And at the end of every month, I would just print out our expenses and I would go over it with my wife. And it's amazing how eye-opening that is. Like, she's a frugal person, but she would look at it and be like, we spent $900 on food. And like, it would just shock us how much we spent on some categories, even though we think that we're doing things well. That just provides you with tools to say, okay, is that money well spent? Is that something that I value? And just by reviewing it regularly, how you're spending, it really changes your behavior.
So why do you do it manually versus having it done electronically?
I started this in 2004, and I like doing it manually because it forces me to relive every expense. And when you're in the moment and you just use your credit card to swipe something, there's a psychology that says that it doesn't hurt you. It doesn't hurt your brain when you're using a credit card versus when you're using cash. But by forcing myself to go through and going through the time-consuming process, I have to relive every expense and re-enter it into my spreadsheet manually. So I just like that it forces me to rethink versus having software that does it automatically, which I think is great for most people. But for me personally, I like to relive every expense twice so that I can feel that pain point the second time.
You have to figure out a system for you, and you have to implement it, and you have to follow it. Now, at the end of the day, though, you need to understand your cash flow, which is what you're basically doing. You're looking at where's my cash flowing, and is it where I want to go? And because you're doing it monthly, you have the ability to make changes. So when your wife looks at it and goes $900 on food, the next month, I bet you your food bill dropped dramatically because it was a pain point, because you were aware of what was going on. And when you feel that, you go ahead and you make the change.
Yes, it's exactly right. And I also like that by using Excel, I could create budgets for each line item for myself and see how I matched up against those budgets at the end of time. When I started this in 2004, I didn't find any free software that could do the same thing. So at this point, it's more, I've done it for 15 years and I'm comfortable with it. But there are a plethora of great software programs out there that can automate a lot of that if you're not into the manual entry thing.
Absolutely. And I know I've heard of Tiller, and I think Tiller actually throws it into spreadsheets. I use Quicken because it's a one-button download, and it goes to all my different places, and it downloads it. But then I physically look at every single transaction gets matched up. So in a sense, I do relive it every month, but it's kind of automated in a sense.
That's great.
So I can go back. I think I started using Quicken back when computers ran on DOS. So I think early 90s. Nice. I've got 30 years of spending history that I can go back and look at and watch the curves and see all the mistakes I made and all the stuff I bought.
That's great. And that sounds like a fantastic system that works for you. I've got one that I'm happy with. And at this point, I've got so much time invested in this spreadsheet that the fact of giving it up is just too painful.
Everyone has to figure out their system. You can't implement someone else's and say, oh, I love it, because you have to build it for yourself. And whatever works for you is perfect. Just figure out what works for you and go do it. And right. It's not that one is right or one is wrong or one is better. It's what's best for you. And I think that's the important thing. So we're here today to talk about stock picking. And I've kind of gone back and forth on this throughout life. There was a time in my life where I spent a lot of time on it, and then I kind of got away from it. These days, I mostly do market funds. And yet at the same point, I think there's risk in just doing market funds, especially with so many people chasing an S&P 500 fund. It may create risks that we don't even understand. But let's just kind of get started. One of the things that you talk about is why professionals fail and how you can succeed in investments.
In the FIRE movement, the financial independence movement, the overwhelming majority of people believe that index funds are the no-brainer, obvious choice. And I wholeheartedly agree with them that index funds are a superior choice when compared to having your money professionally managed or using mutual funds. And I think that they have a number of advantages. However, the thing that I heard over and over again from some people is that people that pick their own stocks are essentially idiots for doing so, because if the professionals can't beat the market over time, what chance would an individual investor have? And the more I've looked at this, the more I've actually learned, and I fully believe that individual investors actually have a massive advantage over professional investors. And just because 90 or 95% of professional money managers fail to beat the market over time doesn't mean that individual investors will experience the same level of failure, basically. In fact, a lot of the individual investors that I know and use smart principles and think and act in the long term actually outperform the market, which if you say that to people that are 100% indexing is the only way to go, they don't believe that. They think that that is just sheer luck, or that's impossible to happen if professionals can't do it.
And just to be clear, you're not talking about day trading because you said long term, correct?
Yeah, day trading is a horrible idea. I mean, if you think that you can day trade better than the smartest hedge funds that have access to the best computers that are within the certain number of feet of the exchanges, you will lose. That is the exact opposite of investing. Day trading is a sucker's game, in my opinion. The only way that an individual investor can beat the market and outperform Wall Street over time is by judging their performance over the long term, which I define as at least 3 years, preferably 5 years or longer. If you can approach buying stocks with the same mindset that a business owner would approach buying a business, then you can do well over time. If you were going to go buy a business, you wouldn't buy it and then sell it later that day for 0.5% profit. You would look at the business and you would say, is this a good business? Does it have a good brand? What kind of profits can I get out of this business over the next 1, 3, 5 years? What are the growth prospects? What are the risks? That's how you would approach the decision to buy it. You wouldn't be interested in flipping it immediately. And that is the exact same mindset that I use and successful individual investors use to buy stocks that are publicly traded.
And so I think it's important that when you're doing something like this, you do have a process in place of how you do it, and you kind of remove the emotions, because that's where people go wrong. They make too many emotional decisions in the stock market. But when you actually have a process and you go through and you follow the process and you stay out of the emotional game, you have a tremendous potential for success.
Yeah, if you ask Warren Buffett what the secret to his success is, then his number one answer isn't, I pick great businesses or I know how to read financial statements better. It's, I have full control over my emotions. And Warren Buffett has been successful over time because he approaches buying stocks as a business owner. He wants to buy companies that he believes can grow revenue and grow profits for decades on end. And when he finds a business that he likes, he buys it and he holds it and he owns it. And he lets that business compound his wealth over time. That is the primary way that he has grown so wealthy over time, is he has bought businesses either outright or partial stakes in publicly traded stocks. And that is the message that he expounds constantly. And if you listen to that message, you can take the principles that he has expounded and use them to buy individual stocks and do well for yourself over time.
And I think one of the things he does that he is extremely good at is understanding the company reports. He knows how to read their different reports and understand what it means and what in the reports is fluff and what in the reports is real and what the projections look like. And then he also evaluates the management team to say, are these the kind of people I want to do business with? He's got an amazing skill set that he has learned over time.
Yeah, what you just said there is really important. Accounting, understanding the financial statements, the income statement, the balance sheet, and the cash flow statement, is just learning the language of business and the language of investing. Once you understand the numbers, you can understand more about how a business runs and what you want to see in the business over time. That's the part of your brain that is purely numerical. That's the part of investing that is purely numerical. And that's an incredibly important skill to learn. However, you have to marry that with the ability to look at a management team, to look at a business's culture, to see if it's a good place to work, to see if it has a product or service that can defend itself from the competition, that will grow more relevant over time. That is a different side of the brain thinking, and it's the marriage of those two things together that make great business stock pickers.
And so today, that's kind of easier than ever. With websites like Glassdoor, you can kind of see what people are saying who work for a company, or through LinkedIn or so many of the other sites. If you put the time and effort into it, can learn a lot about a company's culture and how they do things. And even just looking and Googling them to see what their reputation is and the complaints and the praise for a company is pretty easy to find out. Plus, if you're buying their products, you have a good idea of, is this something that's valuable or not valuable?
You are 100% correct. There are so many free tools available now that give us, as investors, levels of insight into a business that never existed before. And one of the very simple things that I do to pick stocks is every year, Glassdoor comes out with its rankings of 100 highest rated CEOs and 100 best companies to work for. That is a shopping list of stocks to go through, because you know that if it's a great leader to work for, if they have high approvals from their employees, that means that people want to work for the business, that they will have an easy time attracting talent and retaining talent at that company. So every year when that comes out, when those lists comes out of the best companies to work for, I pour through that list. And if there's a name on there that I don't know or recognize, that becomes a stock that I become very interested in learning more about.
That's interesting that you do that. So let's talk about some of the disadvantages that professional money managers have. And just so you know, to me, I look at professional in the financial business as nothing but salespeople, because that's what they're paid to do, is bring in more money. They're not paid to grow the money. But I'd love to hear your thoughts. What are some of the disadvantages that they have that an individual investor may not have?
It just sounds counterintuitive, does it? I can't think of another field where the people that are professionals, that have the most resources, that have access to resources that amateurs do not, how they would be at a disadvantage when compared to people with very limited resources and only a computer at home. That's just a backwards concept. However, I think you said it really well, Rocky, that professional money managers are not in the investment business. They're in the sales business. They are in the assets. They are in the gathering assets business. That's how they are compensated. That's how they are paid. So a money manager with $10 million in assets that outperforms the market will make way less money than one with $1 billion in assets under management that underperforms the market. So the incentive structure around the financial services industry is gathering and retaining assets. So just like a politician's primary job is raising funds so they can get reelected, that is a money manager's job. Their actual job is raising money and keeping the money that they have so they themselves can be enriched.
And I think that's counterintuitive, and I think a lot of people don't realize that. And yet, that's where the incentives are. It's not good or bad, it's just what it is. And so you have to be aware of that as you look to them for their expertise.
Yeah, so you have to know that that's the first thing to know about professionals. That is their yardstick. That is how they are measured. So because of that, all of the actions that they take when they're buying or selling securities are designed around attracting assets and retaining assets. So once you understand that, you can understand that they are structurally incentivized to think and act with the short term in mind, not with the long term in mind. So for example, if a professional money manager goes out and buys a bunch of stocks that they think are great bets over the next year, but those stocks for the long term, for 3 years or 5 years, but that group of stocks, for whatever reason, underperforms the index over a 90-day period, which is how often they have to tell their shareholders what they hold and how their performance was. Even if those businesses are great bets for the long term and the manager really believes in them, they will be punished over the 90-day period by their investors if they underperform the market. Their investors will pull assets out of their company, and that manager will make less money and be in trouble with his boss. So because of that, because they are constantly judged on what was your performance today, the last week, the last month, or the last quarter, They cannot think and act for the long term. That is the reason why you see enormous swings in stock prices over a short period of time, because big money managers that have all this assets have to constantly tinker with their portfolio. They are constantly proving to their clients that they are doing their great job, that they are outperforming the market over the week or the month or 3-month period. So because that's what they are incentivized to do, they don't think about the long-term potential of the business. And they can't take advantage of long-term compounding that great businesses do in the same way that individual investors can. Individual investors that manage their own money don't have any time period. They don't have anybody to report to. They can stop and ask themselves, is this a great company that I want to be a partial shareholder of for the next 5 years and 10 years? If the answer is yes, they can buy that. And if the stock underperforms over the short term, 3 months, 6 months, or if it trips up, they're not responsible to any other person. They are responsible to themselves. They're not going to fire themselves in the same way that a professional money manager would get fired.
And that's very true. One of the other things, though, and you can probably expound on this, is because they have so much money and because they are making such large trades, they actually affect market prices. Whereas you and I going in and buying a stock has literally no effect on its price. Whereas when they're coming in and they're moving $500 million into a company, that dramatically changes the pricing of the stock.
Yeah, it's very true. Warren Buffett has talked about this problem for the last 20 years. Warren Buffett has so much money to invest and deploy that if he wanted to take a position in a company, it would literally move the price of the stock, because he would have to buy hundreds of millions or even billions of dollars worth of that stock if he really liked it. So that limits Warren Buffett, because he has so much money, to say the top 100 biggest or the few hundred biggest companies in the world that can handle that much volume without affecting the price so much. Big professional money managers face a similar quandary. If they want to take a $5 million position in a company and they put an order in all at one time, that would be so much demand for that stock, depending on its size, that it could dramatically in the price. And with investing, if you really like a company at, say, $50 per share, you might not like it as much at $75 per share. The price that you pay does affect your future returns. So the bigger a fund gets, the more money a professional money manager has, the harder it is for them to buy and sell businesses at attractive prices. And that does act as a disadvantage. Whereas if you are a small investor with, say, 10,000, 50,000, 100,000, or even $1 million, you could easily take positions in the company without affecting the price at all.
That you can. And actually, let's just talk about this, because I think people get confused about the price of a stock. One stock is $5, one stock's $100, and another stock's $1,000. And I think people naturally compare just the price of the stock versus the value of the stock.
Yes, that's something that when I first investing, it tripped me up. When I first started out, I thought the smartest way to make money was to buy stocks that cost less than $1 per share, because if a stock's trading at 50 cents, all it has to do is go up another 50 cents and I double my money. But if a stock is trading at $200 per share, it has to gain $200 for me to double my money. And that just seemed like it would take way longer than that penny stock. So that fact attracts so many investors, especially people that are new, including myself, to buy businesses that are trading under $5 per share. In reality, the dollar amount of the price of a stock is meaningless. It literally means nothing. All that tells you is the price of one share. The actual number that matters is the size of the business. And to find out the size of the business, you need to know the price per share, as well as how many shares are outstanding at the company. So as a quick example, let's say a company is worth $1 per share, but that business has a billion shares, then the size of that business is $1 billion. And for that stock to go from $1 to $2, that company value would have to go from $1 billion to $2 billion. Conversely, let's say you had a stock trading at $100 per share, but there was only 1 million shares outstanding. What's the value of that business? It's $100 million. because it's $100 per share times 1 million shares outstanding. So the business that traded at $1 per share is worth $1 billion, and the business that trades at $100 per share is worth $100 million. So the key factor is the size of the business in absolute terms, not the dollar amount of one share. But that's very easy to trip people up.
It is. And then also, what are the earnings per share? Because at the end of the day, your stock is valued on how much money is this company making, and then what is the future expectation of what this company is going to make.
Exactly. So let's go back to that example of the company that was trading at $1 per share. If that company earnings per share was $10 million, $10 million divided by 1 billion shares outstanding would be 1 penny per share in profits. So if the business was trading at $1 and the earnings per share was 1 penny, that business would be trading at 100 times earnings. Conversely, if you take that $100 business, add that's worth $100 million, and that business made the same $10 million, that $10 million divided by 1 million shares means that business is making $10 per share in earnings. $10 per share in earnings divided by that $100 share price would mean that business is trading at 10 times earnings. So it would be cheaper at $100 per share than the 100 times earnings that the dollar per share company was trading at. So it's the ratio of the stock price to the earnings per share that matters far more than the actual dollar amount of a single share.
And that's very true. And then the other thing that has to be looked at is expectations overall, in the sense that what are people willing to pay per earnings per share? So there are times in history where the stock market has a very high PE, in that people are willing to pay a lot for very little. And then there's other times in history where the PEs of the market are very low, meaning people are not willing to pay much for stocks and the valuations going forward. It's funny because when prices are high and PEs are high, everybody wants in. And when PEs are low and prices are cheap, everyone's scared of the stock market. And it's opposite of what reality is. You know, when PEs are low, the stock market's on sale. Right now, PEs are kind of high. They've come down a bunch recently because the stock market's been dropping. People always look at this relative. I see a lot of comments on things. Oh, stocks are cheap right now. And I'm looking going, stocks are cheaper than they were 2 months ago, but they aren't cheap. Cheap is when they're at a fraction of what they are today.
Yes, that's correct. If you look at the PE ratio of the S&P 500, and PE stands for price to earnings ratio, right now it's about 19. I believe that the historic average is somewhere around 16. While the stock prices have fallen, even today, stock prices in general are higher than their 120-year average. So you're right that stock prices have fallen, but in absolute terms, they are still on the high side when compared to history.
And so the thing to realize is that over time, things revert to the mean, which means the chances of things going down from where they are today is highly possible. We don't know when it's going to happen, and no one can pick, and it can stay high above the mean for 10 years. I think people look at things in very short term. These trends are very long, and there are good times and there are bad times, and there have been bad times that have been very long. But since we haven't seen them, we don't think about them and we don't realize that they exist.
Right. And over time, trying to guess where the PE ratio of the S&P 500 is going to be is extremely hard and, in my opinion, a fool's game. That's why the strategy that I advocate for is just investing on a regular schedule every 2 weeks, every month, every 3 months, whatever it is. And no matter where the valuation is at any given time, just put that money into the market, because what matters over time is the growth in earnings. That's what drives returns over a 5 and 10 year period. What the valuation is at any given time is very hard to predict, and where the valuation will be in the future is impossible to know. You're asking, what is the mood of the market going to be 5 years from now, when you're trying to project what stock prices will be worth 5 years from now. But as long as you stick to a regular investing schedule, sometimes you'll be investing when markets are at their high. Other times you'll be buying when markets are at their low. Obviously, when you're paying at the lower price, the odds are in your favor to do better over time. But trying to figure out where you are in the cycle at any given time is extremely difficult.
It is. And nobody knows, including me. And anyone who tells you they know is pulling the wool over your eyes.
That's right.
We will be back to Brian in a moment. Imagine having the expertise that Brian has in stock picking and have the ability to get that knowledge in a fraction of the time. That's what an expert coach can do for you. Share the wisdom and experience to help you move faster and prevent mistakes. That's why it's important to pick a coach who has the knowledge and skill sets you want. For me, it's about understanding money, reducing risk, and creating systems. I talk to my clients about being intentional and deciding what they want, and then creating plans to achieve that. We go far beyond money, because money is just one small part of living a richer, more meaningful life. Are you ready to supercharge your success and save years of struggle? Reach out and see if we're a good fit for your needs. Email for a no-obligation free call to learn more. It's rocky@richersoul.com. Now, let's get back to Brian as we learn how to beat professional investors in the stock market. So what are some of the other reasons that individual investors can beat the professionals?
Well, a major reason is professionals are compensated for their time. A very typical fee that mutual fund manager, for example, will extract from their clients is 1% per year. If you have $100,000 invested with that mutual fund manager, over the course of a year, they're going to extract $1,000, 1%, from your account. If you are in a hedge fund, a very common fee structure is 2% of assets plus 20% of profits. And that is just a massive drag on your return when that compounds over time, because fees compound over time the same way that your capital compounds over time. If you are investing for yourself and you're buying stocks and you're just holding them, after you pay the initial commission to buy the stock, which in some cases can be zero nowadays, depending on which broker you use, you can get it for very cheap. And if you just hold it, there's no cost. There's no ongoing cost to own that stock. That alone acts as a big difference between what you're going to earn from the professionals versus what you can earn on your own. Low costs.
And it's true. That 1% a year compounds over time, and over a lifetime, it becomes a very large number. And I think a lot of people don't realize when you buy mutual funds, even though you're never going to see that 1% line item many times, it's happening behind the scenes. It's happening in a slightly lower return on what you get. But all of these things are getting sucked out behind the scenes, and you don't even see them going away.
That's an amazing fact about the fund industry. I mean, let's just pretend that you did really well in life and you had $1 million invested with a mutual fund or with a financial manager. You are paying that person $10,000 per year to manage that $1 million for you. That is probably one of your biggest expenses, and yet you don't get a bill for it. The only thing you see is your statement's value at the beginning and the middle and the end of the year. You don't see that they pulled $10,000 out of your account. So because it's hidden, a lot of people don't even know that it's happening, but it's a very real expense. The same way that it is with a lot of your listeners today, I'm sure know that they have a 401k. Very few 401ks, I believe, actually show you how much money they extract from your account every quarter. My wife's 401k account does actually show every quarter how much they extract from her account. And at this point, it's several $100s per quarter. And I show that to her, and she says, they're taking that much money just to manage my money? But I applaud them for even showing on a paper that they're taking that much money out. So many fund managers don't even show their clients how much they're taking. And if they just knew, it would absolutely spark change.
It would. And there is change coming about. Tony Robbins' book, Money Master the Game, one of the big ahas in there is just how much money is being sucked out by all of these professional money managers, how much of them are not actually providing value. I think he interviewed like 50 billionaires. When you looked at all their portfolios over a period of 40 years, they all essentially had the same results, regardless of what they did. The biggest driving factor between the success was how much they paid in fees. The more the fees, the worse their outcomes. And over a lifetime, if you think about it, 1% fee over 30 years is 30%, which is a lot of money.
That's 100% true, especially if you're contributing constantly and your account balance is growing. You can just see how much of the value that gets sucked out. And the other really damaging part of the fees is, let's just say you start with $100,000 and it grows 10%, and then they take out 1%. Well, you're still up to, let's say, $109,000. That's still a good outcome. However, if you have $100,000 and the market falls 10%, then they're taking out that $1,000 and you're left with 89. So fees are constant no matter which direction your portfolio is heading in. So there's another reason why keeping control of your costs is such a valuable thing for every investor to do. And that's one of the main reasons that going with index funds over having your money professionally managed is such a win for investors in general, because the fee structure is so much lower. They get to keep that 95% of that fee they would have paid for themselves, which just makes a huge difference over time.
And then it does. Since you brought up 401ks, I think a lot of people don't understand the tax situation. So everyone's like saving for retirement, puts it in tax deferred accounts. And if you put money into a 401k, when you take that money out, you're going to pay taxes as if it was income. But if you actually went and bought the S&P 500 and you never sold it over those same 20 years, you're not paying taxes every year except on a small portion, which is your dividends. But if you're not actually selling, you don't pay taxes. So in a sense, it is tax deferred. If you buy an individual stock and you hold it for 10 years, you're not paying taxes every year on the gain. It is tax deferred. And when it comes time to pay taxes on the gain, capital gains rates are a fraction of what income tax rates are. And so you pay a much lower percentage on it. Now, of course, you pay the taxes up front, but it's good to have a balance between the two of taxable and non-taxable money, because you have a lot more flexibility and a lot more ability to do things when you have money outside of taxable accounts, especially if you want to retire early and enjoy life.
That's correct. That is another advantage of buying and selling individual stocks and choosing to go the individual investor route. I can tell you that some years in, say, 2010, 2011, 2012, my portfolio was growing. But one of the strategies that I employ is to sell my losers and reinvest into my winners. Because I was selling my losers along the way, the value of my portfolio was growing, but I was selling individual stocks that had lost money. So I was actually saving money on my tax bill, even though the value of my portfolio was going up. So when you buy and hold individual stocks, you can actually be very specific with your tax strategies to actually claim to take losses during periods when the value of your portfolio is actually increasing. So it gives you another tool that you can pull to increase your returns over time.
That's not something fund managers care about at all. They're more interested in their taxes, not yours. So they'll just do whatever works for them.
Yeah, in fact, fund managers, any gains that they have that is in a mutual fund are passed along to the fund holder to pay as taxes. So a fund manager has zero incentive or very, very low incentive to buy and hold a stock for longer than a year, because they're not the ones that are paying the taxes. Individual investors do have an incentive to buy and hold for longer a year, because any gains that they have are taxed at a much lower rate than if they're sold during a short-term period. So mutual funds buy and sell all the time because there's no disincentive for them to do so. Any gains that they have are passed along to their fund holders, and they do have to pay taxes on them. So that's another reason why index funds are the right choice, because index funds turned over is so low that the tax bill in any given year is extremely low. But you can actually take it one step further if you're an individual investor, and you can actually garner away to a negative tax bill in some cases.
So let's just talk about index funds, because I think people are somewhat confused about how these things work and how the individual stocks in them are made up. So when you think of an S&P stock index fund, in other words, the S&P 500 is 500 stocks. There's actually a committee that decides which 500 get to stay in the index, which ones come out, and which ones get added, because they do change those investments over time. And actually, if a stock gets added to the S&P 500 index, it actually will outperform and do better, because all of a sudden, everyone's got to buy that stock to mimic the index in all of these different funds. But each individual stock is not equal in that index. These indexes can get way out of balance where a handful of stocks make up a larger portion of the index. And then also performance within those 500 stocks is dramatically varied because it doesn't matter whether the stock is good or bad. If it's in the index, all of the investment managers who invest in the index have to buy the stock. I'd love to hear your thoughts on that.
Yeah, when you think S&P 500, you would think that it's just 500 stocks that are equal divide between those 500 companies and that you're extremely well diversified. You are absolutely extremely well diversified when you use index funds that mimic the S&P 500, but you are more concentrated than you might think because the S&P 500 is market cap weighted. So the bigger a company is, the larger a percentage of your assets are in that one company. So I'm looking at the list of the S&P 500 right now, for example. The number one holding in the S&P 500 is Microsoft. And Microsoft makes up 3.7% of the S&P 500 today. The number two constituent is Apple. Apple makes up 3.4% of the S&P 500 today. And it looks like all of the top 10 are above 1% of the index. If you were to add up those top 10 holdings, it looks like it's about 20%. So 20% of the S&P 500 is in just 10 companies. By contrast, the bottom, say 400 to 500 companies, I don't have the exact number in front of me, but it's probably along the lines of 5% or 10% combined, just because the larger the company is, the bigger component is of the S&P 500. So if you bought $10,000 of the S&P 500 today, $370 of that would be invested into Microsoft. $340 would be invested into Apple. $290 would be invested into Amazon. So that's just the nature of the S&P 500 is that it's market cap weighted versus being equal weight. Equal weight just means that every component would have the exact same weighting, would be invested the exact same 1/500th.
And so it's not as diversified as you think it is. It is highly driven to certain sectors. And as those sectors go, so do the returns. And I don't know the exacts, but I think most of the performance as the S&P 500 has gone up is driven by a handful of stocks.
That is absolutely true, but that's been true throughout history, is that typically a minority of stocks do drive the majority of performance, which is why investing through index funds can be great because you're guaranteed to have all of those stocks in your portfolio to do the heavy lifting for you.
And that's true. The key, though, is if you could figure out what those are and buy them individually.
Yes, that's something that we are passionate advocates for. To taking the time to do the research, to find and sift through the winners is a pursuit that I believe is worthwhile, because if you can find a few winners, just a few of them, and put them into your portfolio in a slightly higher concentration than they are in the S&P 500, you can dramatically outperform the index over time, which is something that I've been able to do over the last 5+ years myself.
So we're going to dig into how you do that. But before we do that, I want to talk to the listeners just quickly about when it's appropriate to do something, right? So you go about baking a cake. We have certain ingredients for the cake. You have to put them together in a certain order, because if you don't, the cake turns out terrible. If you want to get into individual stock investing, it takes a lot of time. And the reality is if you're young, if you don't have a lot of money, just buy index funds, because it's easy, it's quick. Even if you double what the market returns are yourself, because the amount you have is so small, you don't get the benefit of it. Once you have a larger pot to play with and you have the ability to truly allow it to grow, that's when spending the time becomes much more applicable and much more important. So if you've got $10,000 and you make a 10% return, that's $1,000, right? But if you've got $1 million and you make a 10% return, that's $100,000. So if you've got the ability to make $100,000 versus $1,000, you should put more time and investment into making the $100,000 when you're at that point in life. Again, in the meantime, continue to learn and continue to figure this out, but make sure you're putting your time where the money is best suited. And when you're younger and you don't have as much, your time should be going into increasing your income, in areas that you can increase your income the most. So it's just kind of do things in the right order, because when you do, you get the excellent results of a well-baked cake. So how is it that you go about picking individual stocks, and what advice do you have for the listeners?
The most important thing about buying individual stocks is to develop a process for knowing what you're looking for and what you're not looking for. I've been honing my skills for more than 15 years now, and what I found was that two things that have made me an immeasurably better stock picker is using a checklist and using a journal. I maintain a database online where I have a checklist of things that I look for in a business, and it covers the financials. It covers things like, are they profitable? It covers their competitive advantage, what keeps them one step ahead of the competition. It covers things like their future potential. What do their customers say about them? Are their customers dependent on them? Do they repeat purchase? Does the manager get good ratings? Do they own a lot of stock? Do employees like working there? And how has the stock performed historically versus the index? Has it outperformed, which is a great sign, or has it underperformed, which is a terrible sign? So I have developed a checklist that I go through, and every time I come across a business that I'm interested in, I start at the top and I work my way to the bottom. And if it is a company that checks, say, 85 or 90% of the things I'm looking for, I become interested in it and I consider purchasing it. If it does not check the majority of my boxes, I pass and I just skip on to the next business. So I use my ranking system based on my checklist to come up with a numerical value for how interested I am in owning any individual company. And then if it gets a score that I think is great, I buy the stock immediately and I start to track it. And if it does not get a good score, I just completely ignore it, basically. Then when I'm actually purchasing the stock, I would go about and I would buy it, and I would write in my investing journal the primary reasons that I'm buying it, what I expect of the business. I'm buying this business because I think it's going to dominate its industry and it's going to grow. And every 6 months or year, I go back and I look at the company and I see, is this meeting the investing thesis that I have for it? Is it doing what I expected it to do? If it is, I continue to hold it and I may add to my position. If the business, meaning the revenue, the earnings, if the business is not meeting my expectations, then I will consider selling it, irregardless of where the stock price is, irregardless of if the stock is up or if the stock is down. What I'm focused in on is the business meeting the expectations that I laid out for it when I first bought it. If it is, great. If not, I'll consider making a change. That is the basics of my process.
So have you ever let emotions overrule your process?
Yes, I'm human.
And so what usually happens then?
This is something that I've tried to get away from, and this is the reason that I've become such a passionate advocate for using checklists and journals, because by documenting my thoughts and feelings at the time, I can go back and I can review mistakes that I've made and I can correct them. I can tell you that historically, the biggest mistake that I've made with emotions by far is I've bought a stock, the stock has gone up in a short period of time, and then I say, oh, I made a profit, I want to sell, I want to book in my gain today. Several times I've bought great businesses that had everything going for them, I made money and I sold to lock in my gain, and then those stocks continued to go on up from where I sold them. But I let my short-term emotions and excitement about booking a profit override the reason that I bought the stock, which was to profit over a long time. So regularly reviewing my journal, which is where I write down my thoughts and feelings at the time, has helped me to be far more resistant to selling than I had been historically.
It's funny because people do like to sell the winners, but they tend to hold on to the losers, which is a bigger problem because they continue to go down. I was in a stock club for a while, and what we actually did was we started a process of an automatic sell order. And we did it by each stock. We picked a percentage for each stock, which basically said, if this stock drops by X percent, it's automatically going to sell. And it took the entire human emotion out of it. And it really helps to protect against losses. And what it would do is, as the stock went up, it was a trailing stop order. So it's if the stock drops 10% off of its high, it would automatically execute the sale. What that does is it takes the human emotion out. And if you sit down and say, I want back in, well, you can get back in. There's no reason you can't. But it kind of helps to automate that process. And I think what's one of the biggest things I've learned is you've got to build the process, which is what it sounds like you've done. You've got a checklist and a process, and you follow the process. When you get the emotions out of the way, that's when success happens. You don't go asking people what's a good stock. You ask them, hey, what's your process and how do you do it? And you start to improve your particular process and start to build on it. These things take time. So you have to ensure that if you want to do this, you've got to put the time into it. And you've got to have your own process. And I don't know how often you look at stocks, but you need to set the time and follow the process. You can't just do this haphazardly.
Yes. And one of the things that I'll say in response to something that you said before was I started investing in stocks when I was just out of college, when I had very little money. And I will tell you that when I first buying penny stocks, I was lucky enough to have lost a lot of my money. And that taught me so many valuable lessons in the beginning. So I will say, even if you are starting out and you have very little money, I think it's actually a good idea to buy individual stocks when you have little money so that you can start to make the mistakes and you can refine your process when it won't cost you much. If you wait till you have $100,000 before you start delving into this, then the lessons that you learn can be much more costly. And I also believe that there's no rush to this, and there's no reason to just dive headfirst into it before you educate yourself. I'm a big fan, if individual stock picking interests you, is to keep the vast majority of your money and your wealth in index funds, and then layer in on top of them a handful of stocks so that you can start to learn from them. So you take a small percentage of your portfolio and you layer in 5 businesses that interest you. And that will teach you over time what to look for in a business, what interests you. And you can help to define your process that way while still keeping the bulk of your assets in index funds that are growing. And then as you grow more comfortable and gain more experience, you can slowly edge that out to be 5% of your portfolio, 10%, 20%, and you can grow it from there. I think that's a wonderful strategy for dipping your toe in and building out your process over time while still keeping the majority of your assets invested.
Absolutely. It does take time and effort. You have to make a choice for yourself. Do you want to put the time and effort into it, or would you prefer just investing in index funds or doing something else altogether in a whole different market? But again, it always comes back to the same things. Be intentional and put the time and effort into it and build your processes.
Right. I think that's right. And I want to stress, and you stress, is this individual stock picking is not for everybody. A major component of it is, do you have the desire? Do you have the inclination? Do you have the time? And does this interest you? If it does interest you, there are a number of reasons why stock picking can be superior to index funds and having your money managed by others. But if you do not have an interest in this, index funds are a great choice for almost everybody.
Don't do this for the thrill. This isn't gambling. It's work.
That's correct. Yes, it is work, and investing at its best is making smart decisions and developing a process and learning about business and applying them to make intelligent risks. It's not gambling. There are ways to gamble with stocks, but that is a loser's game, in my opinion. That is just gambling, which is just silly.
Absolutely. Is there anything else that you want to share on this topic today, but didn't get a chance to?
I think we covered pretty much all of it. To me, the key takeaways are, if you are an individual investor, as crazy as it sounds, you do have advantages over professionals. It is possible to beat the market if you take advantage of the biggest advantage that you have, which is you are investing for yourself and you can think and act with the long term in mind. If you're willing to devote time to it, learn about business, learn about financial statements, and develop a process for identifying great businesses, I'm very confident that people that are listening to this can outperform the indexes over time.
And you can, if you put the time and the effort and the work into it. But you have to follow the process and do that.
Yes, correct.
It's time to learn The secrets of life. All right. So what's your secret to living life?
Be intentional. Happen to things. Don't have things happen to you. I think a lot of us, I believe it's Dominic Cortuccio that's came up with the term drift, where life kind of moves around and people just do whatever comes their way. The best decisions that I've made in my life has always been me taking action and me being intentional with my time, with my money, to do things that I wanted to do. That's something that's, I think, has to be learned. That's definitely the reason that I've been successful as I am, because I've taken action and I've done the things that took effort.
And intentionality is very important. Have you ever read Outwitting the Devil by Napoleon Hill?
I have not. I'm a big fan of Napoleon Hill.
So Napoleon Hill wrote this book back in the 30s when he was writing his other books. His family wouldn't let him publish it. It didn't actually get published until about 5 or 6 or 7 years ago. And it's literally about the drift and how the devil wins when you're in the drift, and how all of society is kind of designed to put you into the drift. Since you brought that up, it's just something to remind the audience about.
Well, I just reserved it at my library, so I will be reading it next.
Cool. So, what did you learn later in life that you wished you would have learned sooner?
Boy, that's a great question. The thing that I wish I knew earlier in life was be the one that makes plans. Be the one that comes up with activities, and be the one that reaches out to others and invites them to things. Throughout my life, I was always somebody that depended on other people to make plans, to invite me places, and that's not a great formula for life. But a couple of years ago, because of Mr. Money Mustache, actually his blog, he was the one that convinced me that I needed to be the one that organized events and created things and invited other people to it. And once I started doing that, the number of friends that I have in my life has just exploded. And I get to pick things that I think are fun. Like I organize escape room get-togethers with local couples that we're interested in, and we just go and we have a great time. I'm the one that organizes board game nights. I'm the one that organizes chess club. And those are activities that tremendously interest me. But because I'm the one that's doing them, I'm in control of them, and I get to have control over my time.
And control of your time is very important. And again, you decide what you want, what you have fun, and then you build a tribe that wants to join you on that journey, because that is pretty awesome. So, last question is, what's one piece of advice you would give to your younger self?
Boy, I hate to keep humming on the same topic, but I would say be intentional. There were periods of my time when I look back, I was definitely drifting. I was definitely having other people were in charge, and I would just go and float wherever life would take me. That took me to some great places, thankfully, and I did make some choices along the way, but I would just say happen to things. First, be the initiator, as opposed to always being the passive one that just goes along with the flow.
Absolutely. Create your own flow. You control your engine, and you control where you're going, and set your rudder and go there. So based on our conversation today, what's one action step people can take to move forward this week?
If somebody is interested in learning about individual stocks and interested in becoming an investor on their own, I'm a huge believer that the first step is always to educate yourself, to go out and read books. And one book that I think is a great starting point for a lot of people is Warren Buffett and the Interpretation of Financial Statements. That's a book that goes through Warren Buffett's mindset when he's reading a report from a company, and it goes through every line item in the income statement, every line item on the balance sheet, and it says how he thinks about them, what he wants to see, and what he expects, and what makes a business that he's interested in based on the financial statements. So if you know very little about accounting or investing and you have an interest, that's a great book to get started.
I'll kind of add on to that. If you're a small business owner, you should, first of all, you should have your own balance sheet and cash flow and have all of your own statements. But why not learn how Warren Buffett would look at your business, and then look at your business as he does, so that you can be intentional and drive the things that are important in your business to give you the success you want. Because at the end of the day, you're in business to make money. So why not focus on the money?
Oh, that's 100% accurate. I mean, if you are a small business owner and you haven't taken basic accounting class to understand, that is 100% a skill set that every business owner just needs to know is the basics of financials. Even for us everyday normal people, just knowing how to make your own balance sheet, which is more commonly known as a net worth statement, and your own income statement are two skills that everybody should learn that has interest in money.
And we should all have interest in money because it gives us freedom.
I hope so.
So where can people find you and connect with you?
The best places to catch me are on the Motley Fool's website. My handle there is TMF, which stands for The Motley Fool, TMF typo, TYPEOH. You can also find me on Twitter. I'm at Brian Feroldi.
Thank you for sharing this. It's been great chatting with you today.
Rocky, it's been awesome having me on. I really enjoy your podcast. Thank you so much for the time.
Picking stocks is not for everybody, and it takes time. For Brian, it's a passion. For me, it was fraught with mistakes. But that's because I didn't create the process to do this right. At the end of the day, you can make a little bit more money, but you have to balance that versus your interests and time. Investing in the market through a broad-based, low-cost index fund works well for most people. And that's what Warren Buffett suggests. However, that's not what made him rich. This week's action step: educate yourself on investing in stocks by reading books. If you're a small business owner, the book he recommended may help you in how to look at your business and your numbers. As always, be intentional, decide what makes sense for you, and implement a process. If you're still listening, you must have liked the episode. So please share it with a few friends, and if you get a chance, leave a review. I'd appreciate that. You can connect with me on Facebook. There's both a Facebook page and a Facebook group for Richer Soul. What's preventing you from moving forward, and who are you putting on your team to help build the life you deserve? Taking no action creates a far worse outcome in life than trying something and failing. Can I help you achieve your goals through coaching and accountability and putting in place the financial systems to run your business? Just email me, and we can start with a short chat to see if we're a good fit. For many people, one session allows them to take a giant step forward towards their dreams. You can reach me at rocky@richersoul.com. I'd love to hear how you're doing and how the information I've shared has helped. Thanks for listening. Have an abundant week.